Hi there, everyone. I'm Rob McGregor. Welcome to this month's edition of On Track. It's the 27th of November as I speak, and I'm going to dive right in. But before I get started, just letting you know, as usual, this presentation, this monthly video, is recorded for clients of McGregor Wealth Management. And while everyone else is welcome to listen, you should seek advice that's particular to your own needs before you act on anything that we talk about. So I'm going to cover today the latest economic news, what's happening in the markets as markets hit some new highs post the Trump election. We're going to talk about the care portfolio returns, and quite exciting. We've now hit 10 years of documented care portfolio returns, and I'll go through those and talk about interest rates, the economy, and what's happening with property, and try and put everything into perspective for you. So firstly, the big news for the month since we last spoke, Trump wins the US presidency quite comfortably. Looks like won the House and the Senate as well. The share market's reaction was to rise to new highs, but bond yields also jumped up a bit as well. And I'll talk more about that in a minute. And the market's trying to work out what next. Trump obviously doesn't take full power till January. He'll then start putting in policies. Whether he gets all his policies in or not always remains to be seen. There's a lot of checks and balances in the process. That means some of the more radical things may not get in. But the markets going up is pretty much a vote of confidence that the share markets think it's going to be okay at this stage. Doesn't mean they won't change their mind. It's also put some fears back in that US inflation might rise. So the chances of cuts have probably slimmed a little bit. But we'll wait and see. Once again, this is all linked to what Trump might do and what happens in the US. In Australia, the RBA is still talking tough on inflation, even though inflation's dropping. They're looking through to underlying inflation, and that all the ad backs that were manipulated by the government, where they gave people $1,000 to power bills, they're effectively looking through that and underlying inflation. And as I said before, I'm going to show you the care returns over the last 10 years. Just going through the numbers, no change to cash rates, no real change to anything. 10-year bonds had gone were down. You can see in the last 2 months as it got likely and then was confirmed that Trump came in, 10-year bond yields have gone up a bit. Now, generally speaking, you'll see this chart I've got here. As bond yields go up compared to shares, it makes shares potentially more expensive because the alternative risk-free investment of 10-year government bonds pays a bit more. Now, in this case, the bond yields went up, share market went up, but we're starting to think the market looks a little bit expensive, and I'll talk about that in a minute. Not much change in the currency, a little bit weaker as the US was stronger. Last month's number was 2.1% for inflation, but as I said, the Reserve Bank is looking through that, and that this month's number will come out in the next few days. US inflation actually bounced up a little bit. Monthly numbers are never perfectly accurate. It's the patterns over time that matter. So there's a lot of interested parties wanting to see sort of what flows over the next little while on inflation. No real change to mortgages in the Australian market. Every now and then someone drops a rate to try and compete, but there's almost no change. We're starting to see some fixed mortgages slightly lower than the variable rate there, so some in the high fives, but nothing particular. And interestingly, Macquarie are offering slightly more for their one-year term deposits, 4.85%. So we've actually moved the dial up to a 10, and that means the market's starting to look a little bit expensive, not crazy, nothing to worry about. I'll talk about what that means in a minute. And you'll see all of a sudden we have 10 years worth of performance numbers, and those 10-year numbers are very consistent, obviously, with what we've been getting. I'll put them into context as how they compare with the competition, so to speak, but very pleasing that those 10-year numbers are showing, along the lines of the targets that we have there. Inflation plus 4% for balance, 5% for growth, and you'll see they're comfortably done. You'll note in the bottom section there, cash for the last 10 years averaged about 1.92%. So contrast that to a balance to growth portfolio, which has grown 7 to 8%, and a good return for the risk there. So just in the segment that I'm including every month at the moment, exciting life, boring money, not the other way around, it's important to know what to dodge out there as well as what to do. And I look for schemes and scams and traps for this little segment. And one of the ones which came up in the news this month was there's a lot of funding going into NDIS housing, the National Disability Scheme, and that's a good thing. But some cowboys are sort of heading into the market there and trying to offer schemes to get investors into disability housing and talking about the big returns that are possible. We've got some clients that have explored this territory, not many, and they've done it pretty well, but it's taken years and hard work to get to know it. And people offering that they can do that for someone else very easily is probably a bit of a stretch. So something to watch. And if you're thinking about anything along those lines, please talk to us and we can help you with some experience for some others. But certainly some of the people offering this stuff in the marketplace are charging massive fees. And yeah, it's not as simple as it sounds. Our long-term returns and our FOMO, to fear the wall of worry, and you'll see on the right-hand side, the market's jumped into new high territory. Now, that's a good thing. As I've talked about in the last few months, the market makes new highs all the time because it goes up most of the time. So that's not unusual, but I'll put that in perspective. So, yeah, we put the dial to a 10. What does that mean? So it just means the market's looking a bit expensive. You'll note there's still much higher on the dial, 11, 12, 13, 14. But it's based on things like the valuations are getting a little bit harder to justify in the short term. Rising price earnings ratios, that means the earnings yield on shares drops a bit as prices go up, and the market's just got higher. That means there's more likelihood or probability of a small correction in the 5 to 10% region, some possibility of a correction up to 20%, and a small possibility, particularly for markets that are more overinflated, potentially, the Magnificent Seven and things like that, to drop by 20% or more. Doesn't mean it's going to happen, by the way. And it means the investment committee may look to lock in some profits in the active portfolio, which we do from time to time, not very often, but we're certainly in a territory where we'd look at that if it was appropriate. And you should exercise some caution when money's on move. And I'll talk about what that means. But here's what it doesn't mean. It doesn't mean the market's going to go down. It might. It doesn't mean the market's going to crash. It probably won't. And it doesn't mean you should get out of the market. You don't want to be out of, when you look at that blue line that is the market, you don't want to be out of that for many reasons at all, because it goes up all the time. It's hard to get back in. And yeah, it's impossible to predict market movements in the short term. We do our money on the move, so these dials, mainly so that we can help people who are coming into the market, whether they go in quickly or slowly, and I'll talk more about that in a minute. It also helps us assess whether we take some profits from time to time. But yeah, markets can be expensive for years. In the 80s, markets were expensive for 5 years before they corrected, and people that got out early lost a lot of money by not being invested. Company earnings can go up really quickly. The market is pretty much saying, hey, we're confident Trump's going to create a business environment that will mean companies will make more money. And if they do make more money, that'll justify the current prices. And bond yields also may fall. If bond yields fall, that would also justify the current valuation. But for now, we think it's prudent to call that a 10. What it means if we're sitting down with you to do reviews, we'll probably top up the reserves, taking advantage of the high prices. It means if you're looking to pull money out of the portfolio to buy cars, help kids, or whatever, we'd probably take it out of the growth part of the portfolio, not the reserves, and any other one-off withdrawals you might have. If you're thinking about pulling money out to do anything in the next year or so, it may well be prudent to park some of that into reserves, in readiness for that. And for anyone who's retiring the next 3 to 4 years, we'll probably look to start to build, say, an extra year of reserves now rather than waiting until retirement, just while the market's so buoyant. But the key is always have a plan, and for us and you to know your plan. But certainly no change to our long-term investment strategy, just a little bit of caution around the fringes. For investors with fresh cash, who've sold properties, sold businesses, inherited money, then we stagger the money in a bit more slowly when the dial gets up. So we just take a bit more time to put it in, and sometimes be a bit more conservative, or keep some up the sleeve to buy into dips. Any concerns, give us a call, but we certainly have no concern about long-term investment strategy. And here's the numbers, 10 years, and have a look at this. This is an extract from the Lonsec survey of multi-sector diversified funds. And you'll note we now are in the 10-year column, and you'll note the core growth fund in the 60 to 80% growth assets fund sits at number 1 over 10 years. Quite humbling and quite satisfying that we've been able to help clients stay true to label. And as you know, what we aim to be doing is being above average in performance and below average in fees. We're certainly below average in fees, and this is well above average in performance. Now, I want to point out the difference between the top and the bottom, by the way. So you see the core growth fund, the top fund there, the care growth fund, 7.97%. Now, at the bottom of the ladder, UBS, massive company. And you've got IFF, BlackRock's, big companies, over 10 years, 4.7%. So that's a massive difference, 3% over 10 years. That is a staggering amount of money lost to their investors compared to ours. So you see the summary of that down the bottom here. So in the right-hand column, the average fund that's been around for 10 years was just under 5%, 4.94. The best, which was us, 7.97, so 3% clear of that. The worst, 4.88. And you can see the care balanced approach in the top to second quartile over all periods over that 10 years, which is what we aim to do. And the balance side, same story, slightly lower numbers. The balance fund also number one over 10 years, as is the moderate and conservative, by the way, in their respective categories. Same story, top to bottom there, 7 versus 5, and the difference there of 2%. Obviously massive. So we're pleased about that. We don't take that for granted, but it's built, our processes we've talked about it built on structure, systems, not trying to shoot the lights out, just being sensible and making sure that the fees are low enough that doesn't get in the way. Here's the yield curve. So the 10-year bond, you can see the dark green on the top two charts is where it is at the moment. And we saw yield curves go down, then back up again in response to the election, not by a lot, but just by a little bit. They've jumped about 0.3 of 1%. In theory, that makes shares more expensive. That's partly our reason. We may see that drop back as Trump gets into his stride, depending on how aggressive some of the policies are, particularly on the tariffs. The markets don't love talk of tariffs. But Trump likes talking big and then sometimes compromising. There's a lot of positives that may come out if Trump can deliver what he's talked about on ending some wars. That'll be positive for the markets as well. And lowering of corporate tax cuts is partly positive, certainly for the share market. There might be some negatives there around the budget deficit, but watch this space, and certainly nothing to worry about at this stage. So we've talked about the market context in terms of our wall of worry. We're quite clearly still in the wall of worry. We wouldn't have that in boom territory yet. We could be at the start of a boom. I still believe the next boom may be delivered by technology, particularly around AI, and that's certainly started to grow. And this is why you never get out of the market as well, because if we are at the start of a boom, and you never know till years into it, you don't want to have jumped out too early because you'll miss out on the gains that will come when we get those big step changes. By step change, I mean things like the internet. I mean things like the mobile phone, and going back, things like the mass production of washing machines and all these types of things in the 60s. So step changes are where the market has a jump, but on good reasons. And I'm not going to go into that today. We know that market declines always come back. But the psychology at work at the moment, it's going to be interesting to see what the market does as we run into the new year. A good time to point out when I go through mess it up. So mess it up's just the acronyms for all the different ways people can mess up investing. And most people do worse than the market, including institutions, including brokers, everyone else, because they zig and they zag too much, and they burn up money with extra costs. And the average investor earns well under what the average investments go. One of the reasons the care process has been so successful is because we just make sure we don't do that. We don't jump around. We're very careful with our long-term approach, and we only move when we think there's a highly probable reason to move, which is not often. So the one I've highlighted today is timing and selection. We all think we can, but nobody can. So don't be tempted to think because we're saying the market's a bit expensive, it might be time to take a profit or get out of the market. That's certainly not what we are talking about. We're just saying it's a bit warm. And that's okay, because it might get warmer. We might have a bit of volatility. That's okay. We're in this for the long run in terms of your long-term goals and income. Behavioral bias focus today is confirmation bias. And this is the bias where we seek out and like information that confirms whatever we already think. So if we think, I'll give you an example in the market. If we think the market's cheap, we find other information to agree with us that it's cheap. If we think the market's expensive, we'll Google and find information to do that as well. So the key antidote to confirmation bias, because confirmation bias is very dangerous, is to seek out alternative opinions. It's something we do constantly. We look for people that disagree with us. We're happy to have those conversations and happy to build that into our decision-making process. But confirmation bias has never been more of a problem, because on the internet, on all the social media, the algorithms give you information that you want to see. They feed your biases so they can push people further and further down rabbit holes on their beliefs and biases. So something to watch. Same thing in our 4 pillars here. I've pointed out that it's time in, long-term time. You can see those, 10 years return of 8%. That's going to give people a doubling plus of their money over that time compared to cash rate. So that long-term time in the market is what is important. Aussie shares were down slightly on the month, but you can see here since the end of October, November's been pretty much all up. And that includes, of course, the US election. So shares have responded sharply. Same for US shares, straight up from the end of October. So we're now in new highs. It's a good thing for performance. And you can see the strong, towards the end of October, the US share market was up 33%. It's about 38% as we speak. So that's partly contributing why we just said, yeah, it's a little bit expensive at the moment. And we wouldn't be surprised if there's some pullbacks or a bit of volatility in the next few months to the next year. So global leaders, that's the top 100 companies in the world, which includes the Apples, the Nvidias, all those magnificent 7. Same thing, gone up, not as much as the broader shares. You can see it's gone up, but not by as much, but still strong post the election, and certainly another a strong year as well. US small caps have risen sharply. Now, this is really interesting because it means it's a much more broader base than, say, the Magnificent 7 and the big caps. So it's quite promising that the share market's saying, well, for the broader economy and for the broader small caps, which is most of the market, there's a vote of confidence there post-election. Emerging markets actually went the other way. So the fear of tariffs has meant they've gone down a little bit, because that would affect China and other companies that export a lot. So emerging markets post-in, they were up last month in October, but they've gone down since, and they were one sector that went down, as was gold. Gold came down as everything else goes up. And gold often does the exact opposite, so not surprising. But we think gold's really important in the coming years, just because there will be volatility. Whenever there's volatility, gold acts as a hedge there. So let's have a look at what's happening in property, and just a few bits of data that I came across in preparing for this. But you can see the changes in rents, houses on the left, top, units on the right. So it's still rising. So this is the change. So you can see Perth rents went up 9.4% last year. Darwin's the lowest at 2.1%. And units similar, Perth up 10%, Adelaide up 9.4%. And the lowest there's Canberra, only at 1.2%. So the rate of growth looks to be slowing from the craziness that we've had. And the gross rental yields, bottom right-hand corner. So this is the rent you get just divided by the value of the property, about 4.37 in the regions, and combined capital cities about 3.4. And don't forget, you would take off from that any costs of holding property, rates, insurances, etc. So that generally takes anywhere up to about 1% off those yields, which is what you can actually bank. I found the chart on the bottom left fascinating. If you go back to 2020-21, we've had almost a 50% increase in building costs. This is huge. This is partly driving up the cost of property just on the replacement cost alone. It's also driving up the cost of your house insurance, because to replace your house would cost 50% more than it would have just 3 to 4 years ago. So quite staggering. The property prices continue to go up. See bottom left-hand corner there, Perth strongly up 22% over the year, Adelaide 14%, Brisbane 12.5%, Melbourne down. Melbourne's still absorbing the land tax scenario there, where pretty much all investment properties are now subject to land tax. Plus, just a bit of fear. Victoria's got a lot of debt, so it's not a great climate for investing. But our property gurus tell us that's probably going to turn around. When prices stay stagnant long enough, it often creates value and cheap buys. You'll see in the top right-hand corner, this chart's really interesting. It shows the yellow is the lowest 25% of value, so the cheaper areas. The middle is the sort of pink, and the orange is the highest 25% of values. So you can see if I pick on Brisbane, for instance, and this is for the last 3 months, the lowest 25% of values, so call that the entry level, has gone up a lot more than the top end. So 4.5% up compared to 2.1% for the top 21, top 25%. So that tells us there's a lot of competition at first home buyer level, which is keeping prices up. And the bottom right-hand chart there just shows the monthly change in home values across the 5 capital cities. And you'll note that the growth has slowed. It's still growing, but it's slowed. And you can see that, the index has gone, from just on 100 to 200 over that last 10 years. So a double across the country and more in some places. Mortgage rates, boring, no change. Hard to tell when mortgage rates drop, sorry. It will happen, but probably not as much or as quick as people would like or see. And obviously watch for data, but not much happening there. In terms of the property clock from our friends at Performance Property, on the left-hand side, we've got houses. The right-hand side, we've got units. We can see that a lot of leading areas like Melbourne and Sydney are still in that stagnation stage, which we saw with prices going down. Areas like Perth and Brisbane and Adelaide still rising and attractive. But at some point, this is a clock, this is a cycle. Melbourne and Sydney and places on the right-hand side of these charts, like Sydney, Bendigo, Ballarat, Geelong, they will hit that buy value. And that's because if something's down long enough, eventually it becomes good value. And that's definitely going to be the case in the unit world. So in terms of the colours here, the blue is foundation assets that you'd hold for a long time, and the green is what Performance Property would call trading assets, where you'd get in with you taking a profit at the top of the cycle. So in units, they're only foundation assets in Melbourne and Sydney, and they're both stagnating, but Sydney's starting to enter buy value. And there's a lot of talk that units may outperform houses in those cities in particular over the next few years. We will see. No one can ever predict anything, but we like the specialist research we get from these people when we're helping our clients to make decisions about buying or selling. Yell out if you'd like some more information. And that's it as I roll through our philosophy to end it with: exciting life, boring money. Our beliefs that all investing best done as part of a real plan with your goals first, based on what's important to you, portfolio designed to meet those goals, and we take a long-term view. That process has worked brilliantly, as you're seeing from the 10-year returns, through boring stuff like diversification, asset allocation, liquidity, keep the costs low through index funds, and that's something which is coming out in our numbers. And then protect against short-term volatility with the reserves for our retired clients and dollar cost averaging in for our working clients. We rebalance regularly. At the last investment committee meeting, we took little profits out of the share side of things and topping up bonds. So we're doing that on a regular basis, and that adds performance, which helps pay for fees and keeps fees down. Only 3 ways to lose your money. Don't do them. And always happy to say our clients just don't do this, but it's worth reinforcing. Only 3 ways to lose money: panic and sell, have to sell, and not properly diversified. As always, I do appreciate your time and attention. Yell out if there's any questions or things you'd like me to cover in these sessions, and we'll sneak one more in before Christmas as we start to approach the silly season. Enjoy. I'll talk to you next month.